Everyone thinks crashes happen when something goes wrong. A greedy banker, a bad loan, a reckless government. But what if the real trigger isn't chaos? It's precision. What if every boom and collapse follows the same hidden geometry, just faster each time? The truth is, markets don't fall because people panic. They fall because the system does exactly what it was built to do. Too well. When you understand that, 1929, 2008, and 2025 stop looking like isolated crises and start looking like the same movie, replayed in higher resolution. In 1929, they called it Black Tuesday. In 2008, it was the subprime crisis. In 2025, they'll call it something else, the liquidity event, the credit reset, the digital correction. But under the names, the mechanism is the same, an empire of paper wealth outrunning the real economy beneath it. Stocks in the 1920s, mortgage derivatives in the 2000s, digital assets and algorithmic credit in the 2020s. All forms of money that believe they've escaped gravity. Look closer at 1929. The official story says it began with speculation. People buying stocks on margin, brokers lending too much, the market overheated. But why did the brokers lend in the first place? Because the Federal Reserve had flooded banks with cheap credit after 1924 to stabilize Britain's gold reserves. A political decision dressed as monetary policy. The same tool, cheap liquidity, that was meant to prevent collapse, became the fuel for it. Then fast forward to 2008. The story repeats. The US government wanted everyone to own a home. Interest rates stayed low after the 2001 dot-com crash, and Wall Street engineered mortgage-backed securities that looked like risk-free profit. Again, the medicine became the poison. Liquidity turned into leverage. Stabilization turned into speculation. The numbers grew faster than the incomes that were supposed to pay them. And now, 2025. The world swims in more debt, derivatives, and digital claims than at any point in history. Central banks have printed over $30 trillion since 2020. Every country calls it stimulus, quantitative easing, digital liquidity. But the pattern is older than all of them. Every rescue becomes the seed of the next disaster. The paradox is that none of these crashes are errors. They're moments when the math catches up with the myth. When the promises exceed the real world's capacity to deliver. When the paper economy, whether it's stock certificates, mortgage contracts, or digital tokens, meets the limits of human labor, gold, or trust. If you strip away the headlines, every great collapse is the same 7-stage ritual. It begins with invention, a new way to create money, then confidence, then expansion, then illusion, then doubt, then panic, and finally reform, until the next invention restarts the cycle. Arithmetic cannot be deceived. It only waits. If this opened another side of history for you, comment where you're watching from. To understand why every crisis feels new but behaves old, we need to see how the machine itself was built, who designed it, what it replaced, and why it cannot stop expanding. Because markets are not nature, they are architecture. After World War I, the world stood bankrupt, in gold, in trust, in blood. Britain owed the United States over $4 billion, France even more. Germany, crushed by reparations, printed marks until a loaf of bread cost billions. The old gold standard, the idea that every currency had to be backed by real metal, was no longer workable. Yet no empire could admit that openly. So they built a hybrid, a system that looked like gold but ran on credit. It began in 1925 when Britain, under Chancellor Winston Churchill, tried to restore the pound's pre-war parity, pretending £1 still equaled $4.86 as before 1914. To make that illusion hold, the Bank of England had to borrow gold from New York. And the Federal Reserve, still young, created only in 1913, obliged. The Fed lent dollars, the Bank of England converted them into gold. Global credit expanded. The world sighed in relief. Stability, they said, had returned. But it wasn't gold that returned. It was leverage. A new, invisible empire emerged, not of colonies, but of balance sheets. Central banks became the high priests of a new theology: stability through liquidity. Each injection of credit created a wave of apparent prosperity, which then required a larger one to sustain. It was the start of the modern cycle: inflate, crash, rescue, repeat. By the late 1920s, America was the lender of last resort to the entire planet. U.S. banks extended easy loans to Europe, corporations issued bonds bought by ordinary investors. The illusion of infinite credit became the new empire. But empires of paper don't conquer, they absorb. The farmer in Iowa who borrowed to buy a tractor, the Parisian banker investing in American railways, the German industrialist floating bonds in New York, all were now tied to the same heartbeat: the Federal Reserve's discount rate. When that rate moved, the world shook. In 1928, the Fed tightened policy to defend its gold reserves, pulling liquidity out of Europe and Wall Street. Within a year, the system cracked. The same instrument that built the illusion, global credit, withdrew it. Now, fast forward. In 1944, at Bretton Woods, they tried again. This time gold was fixed to the dollar, not every currency to gold. The dollar became the new sun around which all others revolved. For a while it worked, but by the 1960s, America printed more dollars than it had gold to redeem. The math broke again. In 1971, Nixon ended the gold standard altogether. The dollar became pure promise, money backed not by gold, but by confidence. And yet, that confidence was stronger than any metal, because now the empire could print endlessly, and the rest of the world had to accept it. Oil was priced in dollars. Debts were issued in dollars, wars were funded in dollars. The credit machine had gone global. What began as a temporary fix in 1925 became a planetary operating system by 1971. By 2008, that system reached its next frontier: synthetic credit, money made not by printing, but by algorithm. Derivatives, swaps, securitized debt, invisible gold, mined from spreadsheets. When it cracked, central banks did what they always do. They doubled the size of the system to save it. In 2008, they printed $3 trillion. By 2020, over $30 trillion. Each generation inherits the same machine, believing it's new, but the blueprint, the reliance on ever-expanding credit to sustain illusion, hasn't changed since Churchill's pound, since the Fed's first rescue, since the first promise to stabilize what arithmetic refused to balance. If you think this system was built to serve people, look again. It was built to preserve itself. The architects are long gone, but the structure runs on automatic: interest, inflation, intervention. If this helped you see how the system was designed, write in the comments, who do you think controls it now? There's always a moment when everyone believes the system finally works, when even the skeptics give in. That's the phase of illusion. It feels like prosperity, but it's actually pressure building in disguise. The numbers rise faster than questions, and no one wants to stop the music. Look at the late 1920s. The radio crackled with jazz, skyscrapers climbed over Manhattan, and Wall Street invented a new kind of faith: leverage. You could buy a stock with only 10% down. The rest came from borrowed money. Buy now, pay later wasn't just a slogan, it was an ideology. Newspapers published daily lists of new millionaires. J.P. Morgan and National City Bank became temples of the modern age. The Dow Jones rose 400% in 5 years. Everyone said it was the dawn of a permanent prosperity. The illusion felt scientific. Economists of the day insisted that new tools, the Federal Reserve's open market operations, the gold exchange standard, made cycles obsolete. They spoke the same words we heard again in 2006. The system has matured. But arithmetic doesn't age, it repeats. In 2008, the illusion took another form: suburban and digital. A family in Florida bought a house with zero down. A trader in London sold that mortgage to a fund in Zurich, which sliced it into bonds sold to a pension fund in Tokyo. Each layer claimed safety because someone else carried the risk. Diversification, they called it, a beautiful word for collective blindness. Money wasn't printed, it was synthesized. CDOs, MBS, synthetic swaps, financial DNA replicating itself. Like 1928 margin debt, it worked as long as prices rose. Everyone believed they'd discovered a machine that could turn risk into profit forever. Alan Greenspan called it financial innovation. It was really alchemy with spreadsheets. And now, in 2025, we live inside the newest illusion, the digital one. Central bank liquidity meets algorithmic speculation. Real estate, equities, crypto, AI startups, all floating on the same invisible tide of cheap money created since 2020. The post-pandemic boom looked miraculous. Markets doubled, tech valuations exploded, governments borrowed without limit. It felt like progress. But what powered it was the oldest trick in economic history: credit expansion masked as productivity. Think about it. Since 2020, the U.S. Federal Reserve balance sheet grew from 4 trillion to over 8 trillion. The European Central Bank printed 5 trillion euros. Japan, even more. That's not wealth, that's trust turned into digits. And when trust stretches too far, it snaps. The illusion of growth becomes the certainty of imbalance. What connects 1929, 2008, and 2025 isn't technology or policy, it's psychology. In each case, we convince ourselves that this time is different, that new financial tools make old risks disappear, that governments can outprint consequences. The illusion feeds itself through charts, headlines, and algorithms that tell us what we want to hear. Prices go up because they're supposed to. But behind the optimism, the same pattern unfolds. Debts multiply faster than income. Paper claims multiply faster than real assets. And yet no one wants to slow down, because every participant depends on motion. Banks, governments, investors, even households live off expansion. To pause is to collapse. That's why illusions always last longer than reason says they should, and end faster than anyone can react. It's not madness, it's momentum. The system isn't broken during the boom, it's performing perfectly. Like a bridge under too much weight, it doesn't fail until the last car drives on. The phase of illusion is the most seductive stage of all, because it rewards belief and punishes caution. But arithmetic waits, quietly counting. Every dollar borrowed, every percentage of leverage, every digital promise adds up in silence, until the silence breaks. If this made you rethink what growth really means, tell me in the comments. What illusion do you think we're living in now? Then comes the sound, the one every empire hears just before it falls. Not an explosion, but a click. The moment when the machine still spins, but the gears no longer connect. Prices are still high, screens still green, but liquidity, the lifeblood, is already gone. In 1929, the click came quietly. October 24th, Black Thursday. Stocks fell 11% before noon. Bankers rushed to reassure investors, buying blue chips on the floor of the exchange. It worked for a day. Then came Tuesday, October 29th. 16 million shares traded, $30 billion vanished. That was more than the entire annual U.S. federal budget. But even that wasn't the real disaster. The collapse came later in the credit system. Brokers called in loans, farmers defaulted, factories shut. Within 3 years, 5,000 banks failed. Unemployment hit 25%. The myth says it was panic that caused the Great Depression. The truth is colder. It was arithmetic. The debt structure of the 1920s required infinite growth. When growth stopped, the numbers no longer balanced. The collateral that backed the loans, stocks, crops, factories, all fell in price together. The system froze, not because people lost faith, but because there was nothing left to pledge. Now, jump to 2008. The same click, 80 years later, only faster. The first crack appeared in August 2007, when BNP Paribas froze withdrawals from its mortgage funds. But the world didn't notice until Lehman Brothers, September 15, 2008, filed for bankruptcy, with $613 billion in liabilities. The shock wasn't that Lehman failed, it was that the entire market discovered that everyone's assets were someone else's debts. A mortgage in Cleveland could bring down a bank in London. The math of interconnectedness turned one default into a cascade. Then came the silence. No one would lend, even overnight. The global interbank market, the bloodstream of capitalism, simply stopped. It was the financial equivalent of cardiac arrest. Governments responded with bailouts, rescues, and what they called quantitative easing. But all they really did was restart the same heart with a larger shock. The numbers doubled. And here we are, 2025. The system has learned to collapse faster and recover faster because the digital layer amplifies both illusion and panic. What once took years now unfolds in days. A rumor on social media can erase billions. A single policy comment can trigger global sell-offs. The markets no longer move by trade, they move by belief. Already we've seen the early tremors. Real estate defaults in China, regional bank failures in the US, sovereign debt warnings in Europe. The same mathematics again. Debt growing faster than income, derivatives magnifying every move, governments trapped between inflation and insolvency. But this time the liquidity isn't gold or paper, it's data. When trust vanishes, not even central banks can print confidence. Collapse always exposes what growth hides. In 1929, it revealed the fragility of the gold illusion. In 2008, the fraud of financial engineering. In 2025, it reveals the dependence of everything, from pensions to AI companies, on artificial liquidity. The numbers are beautiful until they stop moving. Then they become weights. And every empire of credit ends the same way, with the return of arithmetic. Not morality, not politics, arithmetic. You can delay it with words, policies, or hope, but not forever. Every bailout borrows time from tomorrow, and tomorrow eventually arrives. If you feel this moment tightening, if you sense that the next click is near, you're not imagining it. The pattern is old, but the speed is new. If this helped you see how collapses really begin, write in the comments. What sign do you think will mark the next one? After every collapse, the world swears it has learned. New laws, new regulators, new promises that this will never happen again. But the deeper you look, the clearer it becomes. The system doesn't reform, it mutates. It adapts the same mechanism to a new disguise. The names change, the speed increases, but the structure remains. Debt replaces trust, credit replaces production, and each rescue plants the next crisis. In the 1930s, the Great Depression gave birth to the modern state economy. Governments, not markets, became the saviors. Roosevelt's New Deal injected public money into private collapse. The Fed learned to manage demand. And what followed was 4 decades of managed capitalism, a system built not on free markets, but on the controlled expansion of debt. The illusion of stability was restored, but only by chaining it to politics. By the 1970s, those political promises met their limit. Vietnam, oil shocks, and social spending drained U.S. gold reserves. Nixon's 1971 decree, closing the gold window, broke the last link between money and matter. From that moment, dollars were no longer receipts for gold. They were claims on the future. Credit itself became currency. And when money no longer had to be backed, every government learned the same trick: solve every problem with more liquidity. The 1980s brought the next echo: deregulation and globalization. Markets reopened, capital moved freely, computers replaced clerks. Wall Street became the empire's new capital. But look closer. Behind the language of innovation lay the same addiction: growth by leverage. The Reagan years, Thatcher's Britain, the Plaza Accord of 1985, all different fronts of the same battle, sustaining an illusion of prosperity through debt expansion. Then came 2008. The crisis of credit became the crisis of confidence. To save the system, central banks printed at a scale unseen in history. The Fed's balance sheet tripled. Europe followed. Japan never stopped. But the rescue created something new: quantitative addiction. The markets discovered that prices no longer depended on profits, but on promises of intervention. Every crash became a cue for another flood of liquidity. And in the 2020s, that logic went digital. Trillions appeared not as printed notes, but as numbers on central bank screens. Pandemic relief, digital bonds, CBDCs, central bank digital currencies, all extensions of the same principle. Control the flow, not the source. The money became programmable. But programmable money means programmable behavior. The same institutions that once stabilized banks now stabilize people through stimulus, credits, or restrictions. Look around in 2025. Debt to GDP ratios above 100% are normal. Japan is near 260%. The United States over 120%. Europe hovers just below. Interest payments alone consume the equivalent of entire national budgets. Yet the stock markets rise, unemployment stays low, and headlines cheer soft landings. It feels safe, exactly as it did before every previous fall. But here's the echo that matters most. What was once global capitalism has become global monetarism, an economy not of production but of perpetual refinancing. The same banks that were bailed out in 2008 now buy government bonds with money created by those same governments. It's a circle, closed and self-reinforcing. Like the late Roman Empire debasing its coins, or revolutionary France printing assignats, or Weimar Germany minting marks by the ton, the form evolves, the math repeats. In the end, the consequence of every rescue is dependency. Societies learn to measure stability not by wealth, but by the frequency of intervention. Central banks, once servants, become rulers by default. Every rate cut, every bond purchase, every rescue fund, another vote of no confidence in the real economy. And so the echo of 1929 lives inside 2025, not as memory but as code. The credit machine has become the operating system of civilization, and when it breaks, it won't be called a crash, it will be called a reset. If you see how the past hides inside the present, share this video. The echo only grows louder when ignored. Every age thinks it is smarter than the last one. That's why history always repeats, only faster. The crash of 1929 looked like a tragedy of ignorance. The crash of 2008 looked like a tragedy of greed. But the crash of 2025, this one is a tragedy of memory. We knew the pattern, we mapped the data, we had a century of warnings, and we still built the same structure, only taller and thinner. Because the real addiction isn't to money. It's to the illusion of control. We believe that with enough algorithms, liquidity, and policy tools, we can bend arithmetic to will. That we can inflate forever, stimulate forever, postpone every reckoning. But in the end, numbers don't obey optimism. They obey balance. Every empire in history met this same equation. Rome debased its silver denarius until it was copper. France printed assignats until bread cost a nation. The British Empire leveraged colonies until debt outweighed gold. And now, the digital empires of the 21st century mint credit until trust itself becomes currency. We call it progress, but it's really acceleration. The same 7 stages that once unfolded over generations now loop every decade, every few years, maybe soon every few months. The mechanism didn't change, only its speed. And here lies the final paradox. Every crash, no matter how catastrophic, is also purification. It strips away illusion, resets arithmetic, and forces honesty back into systems built on hope. The market is cruel, but not unjust. It does not punish morality, it punishes imbalance. If you're hearing this in 2025, understand that you are living in one of those hinge moments. When empires of paper, data, and credit face the mirror of reality. When liquidity runs faster than meaning. When the numbers say more about belief than production. The question isn't whether the cycle will end. It's who will own the assets when it resets, and who will still believe in the promises that vanish. History doesn't reward the loud or the optimistic. It rewards the prepared. Those who can see through the fog of innovation to the geometry beneath. Debt, leverage, trust, and time. Because systems don't collapse because of bad people. They collapse when the math outgrows the gold, the income, or the faith that sustains it. Arithmetic is patient. It waits through centuries, through revolutions, through every new currency and every new illusion, and then, all at once, it settles the account. If this made you see the rhythm beneath the headlines, share it, because the next cycle has already begun.